Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what all these corporate filings are trying to hide or maybe reveal. Today we're diving into a shareholder report from Northern Lights Fund Trust III, and boy is it packed. Get ready for a deep dive into how some investment funds have been performing, what it costs to invest, and where your money is actually going. And hey, if you love getting these insights without the financial jargon overload, make sure you hit that subscribe button and check out our Discord community, linked in the description below, where we break down even more. So we're looking at a report for the period ending the 30th of September 2025. It covers a bunch of different funds under the Northern Lights banner, mostly focused on investing. The main story here is performance and costs. For example, take the Absolute Capital Asset Allocator Fund. If you had invested $10,000 when it started back in December 2015, by September 2025, that investment would have grown to over $16,600. That's a pretty decent return, showing that the fund has grown your money over the years. Now, let's narrow it down to just the last year, from October 2024 to September 2025. For the class of shares of the Absolute Capital Asset Allocator Fund, it gained about 11.50%. That is good, and the report even says it beat some of its benchmark indexes, like the Dow Jones Moderately Conservative Portfolio Index. They also mentioned that the fund's assets grew by almost 25% that year, which is a really strong sign of growth and investor confidence. But you always have to look at the costs for that same $10,000 hypothetical investment in class of shares. The cost for the year was $186, which works out to about 1.76% of your investment. This is kind of important because over time, these fees can really eat into your returns. They share similar cost breakdowns for other share classes like institutional class and investor class, which have different fee structures. Let's peek at where the money is actually invested. For the Absolute Capital Asset Allocator Fund, a big chunk, 62.4%, is in equities, meaning stocks. They've also got about 10.7% in money market funds, which are generally considered safe, and 8.2% in US Treasury obligations, also quite safe. This mix suggests a strategy that is aiming for growth, but also keeping a good portion of the money in more stable assets. When we look at the top investments, it is mostly exchange-traded funds or ETFs that hold a variety of stocks. Things like the iShares Core Dividend ETF, Vanguard S&P 500 Growth ETF, and US Treasury bills are all in the top holdings. This tells us the fund is using a diversified approach, spreading its bets across different types of investments. Now, let's switch gears to another fund in the report, the Absolute Capital Defender Fund. This one seems to have a slightly different strategy. For class of shares, the performance over the last year was a gain of about 9.21%. This is lower than the Asset Allocator Fund, but still positive. The report notes that this fund also beat some of its benchmark indexes, like the Dow Jones Conservative Portfolio Index. For the Defender Fund's class of shares, the cost on that hypothetical $10,000 investment was $206, about 1.97%. This is a bit higher than the Asset Allocator Fund, which could make a difference over a long period. Looking at its sector weighting, this fund is also heavily invested in equities, around 57.5%, but it holds a larger portion in US Treasury obligations at 16.6% compared to the Asset Allocator Fund. This suggests a more defensive tilt, perhaps aiming to protect capital a bit more. Its top holdings include ETFs like the SPDR S&P 1500 Value Tilt ETF and iShares Core Dividend ETF, along with US Treasury bills and notes. This again points to a diversified strategy with a significant allocation to fixed income, likely for stability. Moving on to the T-Berg Fund, its no-load class shares clocked in a really strong 13.93% gain for the year. This is the highest performance we've seen among the funds discussed so far. The report highlights that much of this strong performance came from the technology sector, with a semiconductor ETF being the top performer. The cost for a hypothetical $10,000 investment in T-Berg's no-load class was $191, about 1.78%. While the performance was great, it is always good to keep an eye on these costs, especially as they can add up. For the T-Berg Fund, equities make up a massive 80% of its net assets. This aggressive allocation is likely what fueled that impressive 13.93% return. They also hold about 7.1% in US Treasury obligations and a smaller portion in financial services. The top holdings here are heavily tilted towards technology and broad market ETFs, like the VanEck Semiconductor ETF and the Invesco QQ Trust, which is known for tracking many of the biggest tech companies. This confirms that the fund strategy is very focused on growth, particularly in the tech sector. Now, let's look at the overall financials and what this means. We see the net assets for the Absolute Capital Asset Allocator Fund were over $60 million. That's a solid amount of money managed. portfolio turnover, which is how often they buy and sell assets, was 78%. This isn't super high, suggesting they are not day trading, but not extremely low either. For the Absolute Capital Defender Fund, net assets were around $27 million. Their portfolio turnover was also 78%, similar to the Asset Allocator Fund. The T-Berg Fund had the largest net assets at over $73 million. Interestingly, its portfolio turnover rate was much lower at just 2%. This suggests a more buy and hold strategy, which aligns with its strong long-term performance. What is really interesting is the advisory fee. For the Asset Allocator Fund, the advisory fee was over $500,000. For the Defender Fund, it was around $260,000, and for T-Berg, it was over $620,000. These are the fees paid to the managers. They also have these fee waivers and expense reimbursements, which essentially mean the advisor is agreeing to cap certain costs for a while. This is a good sign, showing they are trying to keep costs down for investors. Looking at the financial statements, we can see these funds are structured as series within the Northern Lights Fund Trust III. They all operate with a goal of managing investments and generating returns. The notes to the financial statements are full of important details, like how they value their investments, which is crucial for understanding how fair market prices are determined. Most of their investments are valued based on quoted prices in active markets, which is good. It means their value is pretty transparent. One interesting thing they discuss is principal investment risks. This is where they lay out all the things that could go wrong, like emerging market risks, market and geopolitical risks, and even the risk that their investment choices might not pan out. They are upfront about the fact that you could lose money. This is standard for any investment, but good to see they are outlining it clearly. I also noticed a section about control ownership, where it lists who owns more than 25% of certain funds, for the Allocator and Defender funds. National Financial Services LLC owns a significant chunk, and for the T-Berg Fund, it is Constellation Trust and National Financial Services LLC. This tells us that large institutional investors hold a substantial interest in these funds. Now, for my take, these funds, particularly the T-Berg Fund, have shown some impressive performance, especially over the longer term. The Asset Allocator and Defender funds also delivered positive returns, though with slightly higher costs and a more defensive posture. The fact that they are using ETFs, which are already diversified, and also holding substantial amounts in safe assets like US Treasury bills and money market funds, suggests a well-managed, diversified approach for most of these funds, with the T-Berg Fund taking a more aggressive, higher reward stance. The biggest takeaway for me is the transparency around costs and risks. While they all delivered positive returns, understanding those fees and the associated risks is critical. The expense ratios, even after waivers, are something to watch. For example, the investor class shares of the Asset Allocator Fund have an expense ratio of 2.51%, which is on the higher side. This means a significant portion of your potential gains would go towards fees. The investment strategy seems sound, focusing on diversification and using ETFs. However, as with any investment, past performance is not a guarantee of future results. The board's review of the advisory agreements also offers insight into their diligence, noting performance against benchmarks and peer groups, and a commitment to keeping fees reasonable, especially with expense limitations. Overall, these reports paint a picture of investment funds striving for growth, managing risks and being relatively transparent about their operations and costs. While the returns can be attractive, always remember to dig into those fees and understand the underlying strategy before investing. Alright, that is our breakdown of this extensive SEC filing. What do you think of these fund performances and their strategies? Are these the kinds of investments you'd consider? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a like, subscribe for more corporate deep dives, and don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you in the next video.